Our mission today is we want to explore finance as a deeply human story. Think of it as this framework, right? For dealing with all the chaos in the world, for figuring out what value actually means, how to handle failure, and why commitment is so incredibly important.
That's a completely different angle. And the sources you sent over, they really connect finance to history, philosophy. It's full of these surprising links.
Exactly. We're hoping to pull out some, really startling ideas for you today. Like, did you know that understanding the basics of insurance actually helped eventually to end the persecution of witches?
Seriously. Wow, okay. And you also mentioned something about a mistake in French finance accidentally sparking the revolution?
A massive annuity pricing error, yes. A huge fiscal disaster born from not understanding risk. And then there's the Tootsie Roll Company.
Right. Why did their stock jump 7% when the CEO died? That seems counterintuitive.
It does, doesn't it?
Right.
But it tells a fascinating story about who's really in charge. These are the human dramas hidden in the numbers.
Okay, so if finance is about facing disorder, we kind of have to start way back before we even thought we could manage risk, back with the ancients.
Absolutely. For thousands of years, outcomes weren't analyzed. They were just assigned to the gods, to fate. Think of the Roman goddess Fortuna.
And her wheel, right, the Rota Fortunae, the Wheel of Fortune.
That image was incredibly powerful. It's all over medieval thought. Chaucer, Dante use it. It basically meant your fate, rich or poor, was totally random. Outside human reason, completely up to higher powers.
So it's just divine whim. You can't predict it, you can't manage it.
Pretty much. And Christianity, in many ways, reinforced this view of divine will being, unknowable. The big change, the breakthrough, only came later, with the Renaissance, rationalism, global trade heating up.
People needed ways to handle the risks, especially at sea.
Exactly. And that's where we see the beginnings of probabilistic thinking. The crucial moment, intellectually, is often pinned to 1654.
That's the Pascal and Fermat correspondence, isn't it?
That's the one. They were tackling this puzzle, the problem of points. Like, how do you split the winnings fairly if a game gets interrupted?
Okay.
Their big idea was shifting focus. Not just what did happen, but what could have happened. Calculating the odds, the expected values, that really kicked off the whole field.
Right. Suddenly, chance becomes something you can analyze. But you mentioned this led to a kind of new fatalism, swapping gods for stats.
Yeah, that's the irony. Fast forward to the 19th century, Francis Galton. He discovers the normal distribution, the bell curve.
It's bell curve, right.
He noticed that all sorts of random things, height, errors, whatever they reliably cluster around an average, there's an order in the randomness.
And he had that device, the quincunx, to show it.
Yes, like a simple pachinko machine. Drop one ball, it bounces randomly. Drop thousands, they pile up perfectly into that bell shape.
So individual events are chaos, but the big picture is predictable, mathematical.
Exactly. Galton called it the supreme law of unreason. It felt like the whims of Fortuna were replaced by these cold, hard laws of statistics, a new kind of inescapable order.
Okay, so we have statistical order. How did we immediately start using that? You mentioned maritime risk earlier. Insurance.
Well, yeah, insurance really grew out of that need to manage sea voyages. Think about the contract of bottomry.
Bottomry.
Yeah. Before that, if a merchant borrowed money for a voyage and lost the cargo, they were personally ruined. Could even be enslaved for the debt.
Wow.
The bottomry contract was clever. It bundled the loan with insurance. You paid a higher interest rate, sure, but if the ship sank or pirates attacked, you weren't personally liable anymore. It's structured risk sharing.
Sharing the risk. That idea itself is ancient, isn't it? Like the rules of jettison.
The Lex Rhodia, the law of general average, goes way back, like 1000 BC.
Yeah.
If cargo had to be thrown overboard, jettisoned to save the ship.
Everyone whose stuff was saved had to chip in to compensate the person whose stuff was tossed.
Precisely. The loss was shared across the whole venture. The collective absorbed the blow.
Okay, hang on. You connected this earlier to witches. How does a technical thing like maritime insurance relate to ending witch hunts? That seems like a huge leap.
It does, but think about it. Before formal insurance, when disaster struck a crop failure, a sickness, people looked for someone to blame, right?
Yeah, unfortunately.
Punishing a supposed witch was, in a grim social way, a kind of insurance, a ritual to ward off future bad luck, assign blame. But as former, secular insurance developed.
It provided a different explanation, a non-supernatural one.
Exactly. It gave a rational, technical mechanism for dealing with misfortune. Slowly, very slowly, the focus shifted from blaming your neighbor to, say, flaws in the insurance system, or just accepting bad luck as statistically possible. It helped secularize misfortune.
That is profound. A financial tool having a massive social impact. Okay, let's flip that. Understanding risk helps create insurance, but it also creates ways to manage living too long, right? Longevity risk, annuities.
Yes, the fear of outliving your savings. Annuities became vital for public finance, especially in 18th century Europe. The idea is simple. You pay a lump sum, you get payments for life.
But the payments should depend on your age, surely. A 5-year-old should get less per year than an 80-year-old for the same investment.
Logically, yes. Because the 5-year-old will likely collect for decades longer. You need mortality tables to price it right.
And Louis VI ministers didn't do that.
In a desperate attempt to raise funds, no. They offer the same annual payment rate to everyone. 5-year-olds, 80-year-olds, same deal.
Oh, boy. That's asking for trouble.
It's a textbook case of adverse selection. Who's going to buy those annuities?
Only people who expect to live a very, very long time. Young, healthy people.
Precisely. The state ended up massively subsidizing the long-lived. It blew a gigantic hole in the royal finances. This wasn't just a small error. It contributed significantly to the fiscal crisis that led straight to the French Revolution.
So mispricing risk doesn't just bankrupt a company, it can destabilize a whole country.
Wow. Okay, let's connect this idea of commitment, like the government's annuity commitment, to leverage. Borrowing. Why do we call it leverage?
Think of Archimedes and the lever, right? Give me a place to stand and I shall move the earth. Leverage is a tool. It lets you control assets, access opportunities, buy a house, get an education that are bigger than your current cash pile.
It lets you move things you couldn't otherwise move.
Exactly, but it's an amplifier. That's key.
How so?
Simple example. Say you have $100 in cash. You borrow $400, that's 80% leverage to buy a $500 house.
Okay.
If the house price goes up 10%, that's a $50 gain. But your initial $100 equity, that's just jumped by 50%. Huge amplification.
But the downside is amplified just as much. If that $500 house falls 20% in value, that's a $100 loss. Your entire $100 equity is wiped out. Gone.
Ouch. So leverage cuts both ways, hard. And the big danger is something called debt overhang.
Right. This happens when you're already so burdened by old debt that you can't make good decisions about the future, even beneficial ones.
Like the homeowner whose house is worth less than their mortgage. Say, house worth $70, mortgage is $80.
Perfect example. Now, imagine that homeowner sees a chance to spend $2,500 on a repair that will definitely add $3,000 to the home's value. A clear win, right?
Logically, yes. Do it.
But they probably won't. Because that first $1,000 of the value increase effectively goes straight to the bank to cover the underwater portion of the mortgage. The homeowner does the work, takes the risk, but the bank gets the initial benefit.
So the old debt prevents new value from being created. It just hangs over everything.
Exactly. The shadow of the past commitment freezes beneficial action. And this isn't just financial.
You're saying this applies emotional.
Absolutely. Think about Mr. Stevens in The Remains of the Day. His life is defined by his commitment to dignity, to service. These are his existing debts.
He can't escape them.
And because he's so leveraged to those past commitments, he can't take a new risk, like pursuing a real relationship with Ms. Kenton. He avoids the new investment because his existing emotional structure won't let him benefit. It leads to this profound emotional poverty. Debt overhang, but for the soul.
That's a powerful and frankly quite sad connection. The inability to renegotiate the past prevents a richer future. Okay, taking this structure to the corporate world, the principal-agent problem.
Yeah, this is a huge theme in modern finance. You have owners, the principals, who are often scattered, diffuse shareholders, and they hire managers, the agents, like the CEO, to run the company.
But the managers know more about the day-to-day than the owners. Information asymmetry.
Right. And that gap allows the agent, the CEO, to potentially pursue their own goals. Maybe it's empire building. Maybe it's ridiculously fancy headquarters that strokes the CEO's ego more than it helps profits. It's not always aligned with the principal's goal of, say, maximizing share value.
Which brings us back, finally, to Tootsie Roll. CEO Melvin Gordon dies after 50 years, stock jumps 7%.
Yeah, it seems weird. You'd expect market uncertainty, maybe a dip. But the jump suggests shareholders felt Gordon, the agent, was maybe not acting in their best interest. He'd resisted takeover bids, like from Carl Icahn.
So the market saw his death as unlocking potential value, removing an obstacle.
That's the simple read. But the source calls it a muddle, and I think that's right, because the Gordon family weren't just agents through the CEO, they were also the controlling principals, the main shareholder.
Okay, so they were owner-managers.
Yes, and they argued they were serving principals, just a wider set, not just shareholders, but employees, the community, the customers. They claimed a broader mission than just profit.
So, who is the principal? Who is the agent? It gets complicated. Conflicting goals, maybe inefficient results because nobody agrees on the objective.
Exactly. It shows how messy agency can be in the real world. And, this framework isn't just for corporations.
How so? For us?
Yeah. Think about it. How often do we act as, well, unwitting agents, driven by things from our past, maybe childhood patterns, parental expectations we never consciously signed up for?
The source mentioned Alice Miller's idea of the gifted child, the kid who becomes incredibly good at meeting their parents' needs.
Right. They become amazing agents, high achievers, but
But they struggle to figure out what they actually want. They never learn to be their own principal.
precisely, they were always executing someone else's agenda. So the principal agent idea is useful, personally. It makes you ask, am I running my own life, setting my own goals, or am I unconsciously acting out a script written by someone else, by my past?
Moving from unwitting agent to conscious principal. That's the aim.
And that journey ultimately requires, well, humility.
Oh,
Which brings us to the last big idea. In finance, everyone chases alpha, beating the market, showing skill.
but the parable of the talents reminds us it's hard to know if it's skill or just luck.
It's incredibly hard. Performance is tangled up with randomness. That coin-flipping thought experiment is brutal but effective.
Get 100 people to flip a coin 10 times.
And odds are someone will flip 10 heads in a row. Pure chance. But they look like a genius. They're indistinguishable statistically from an investor who beats the market 10 years straight by sheer luck.
And since there are thousands of investors, some will have amazing lucky streaks.
Exactly. It forces humility. You can't just assume success equals skill. Luck plays a massive role.
Which leads to Alexandra Berkson in O Pioneers as the ultimate finance hero. That's unexpected.
It is, but think about what she did. She understood leverage instinctively. When everyone else panicked during the drought and wanted to sell their Nebraska farmland.
She doubled down, mortgaged everything, bought more land. A huge leveraged bet.
Massive risk.
Yeah.
And she diversified, not just land, but relationships. She listened to Ivar, the eccentric outsider everyone else dismissed, because he had different ideas about farming.
Yeah.
She valued unconventional assets.
But the key part is what happened after she succeeded, right? Her reaction.
That's the crucial lesson. When people ask how she got so rich, she didn't boast about her foresight or genius.
What did she say?
She said, "The land did it. It woke up. We suddenly found we were rich just from sitting still." Pure humility, acknowledging the role of external forces, of luck, the land waking up.
Wow.
And then her final thought completely reframes value. She talks about the land enduring beyond individuals.
We come and go, but the land is always here. And the people who love it and understand it are the people who own it for a little while.
For a little while. That's it. The deepest financial wisdom isn't about accumulation, it's about stewardship. Taking calculated risks, yes, using leverage wisely, but always with the humility to recognize luck and the understanding that we're just temporary caretakers of the value we create or manage.